Thanks for attending, and first thanks to Aurora for inviting us to Paris and for this very nice venue. Otherwise, yesterday was very hot, today is better, so I hope everybody feeling good today. The topic of my talk today will be the DeFi and the future of DeFi, how we see it in Atomic Green. But before we will speak about the future, we need to discuss the actual state of DeFi, how it is now. What are the first words that are coming to the people's minds when they hear the word DeFi? Apart from decentralized, 24/7 accessible, not controlled by anybody, couldn't be blocked, I think the three words that describe DeFi now could be DEXs, lending, and farming. This is how people, the majority of people, probably they understand the DeFi now. In our point of view, this represents DeFi in a very embryonic state, but it's just a baby just born, but it has a lot of room to grow and a lot of time to pass until it develops. But not to be unfounded about this, I wanted to look through several charts comparing the traditional financial markets to the crypto markets, and then we'll be able to move to the future of the DeFi based on this. If you look on this chart, in the traditional financial system, derivatives, they represent the majority part of all the volumes, with more than $600 trillion in the total value of the derivatives only. And you see that crypto is just at the end. And derivatives could be the top or just the basis of all the traditional financial systems. If we are diving deeper to the market size ratios, you can see that this is like the real size sometimes. That the world derivative market is very big, and this is the major system, the major financial system, where the derivatives, they form the basis of all the markets. And the DeFi, it's somewhere there at the end with a total DeFi value of 59 billion, probably now it's a bit bigger. And the derivative markets in DeFi, it's only $1.3, $1.5 billion. It's very small, very tiny. And at this point, we told to us, whoa, there is a big room to grow comparing to the traditional financial systems. So, diving deeper to the derivatives and the crypto, we wanted to share the overall volumes of the derivative trading on centralized exchanges, crypto exchanges, which is 290 billion daily. And the spot market trading on DEXs is only 120 billion. So as you can see, in the centralized crypto market, this ratio is not so bad comparing to the traditional financial market. It's bigger, the derivatives. But if we go to the decentralized exchanges, it's vice versa. And the derivatives trading on the DEXs are only 1.3, 1.5 billion daily, while the spot trading is almost twice bigger. This is the second time we told to us, whoa, there is a room to grow in the decentralized derivatives. But before we start about the future, what we're missing in DeFi comparing to the traditional financial systems? Sometimes they are represented already, but they are very tiny and very rudimentary and have to be developed. These are insurances, interest swaps. It's a very difficult theme in the financial world, traditional system, but it could be translated to the crypto as well and to the derivatives. Then bonds. Everyone know what is bonds? And somehow there exist some types of bonds now in crypto. And forwards. This is more technical thing about the options forward, but all of these form part of derivatives. So probably you understood that the future of DeFi, in our point of view, is building the very basics fundamentals as derivatives, because derivatives should be at the very fundamental and form all what is building up and front for the decentralized finance. But why derivatives are so important? Because it's the essential things to the traditional markets, and it's essential things to the crypto economy, because their functionality extends far beyond the unique investment portfolio. Derivatives were existed to hedge the risks of the professional players like traders, banks, investment firms, because financial systems are built up to financial markets, And financial markets are all about the risks. And professional players, they want to hedge their risks. They want to protect themselves from some events, unpredictable events, such as high price volatility. And this is where derivatives, they're coming into the game with the futures and options. So in our point of view, if we will develop and will have very well developed the derivative system, the DeFi will grow exponentially together with the derivatives. This is the thing that actually derivatives are for. It's hedging and speculations. But for now, in DeFi, we see only speculations, but there is almost no hedging. People don't use it for hedging. But moreover, speaking about the crypto derivatives, there are a few very inherent advantages of them comparing to the traditional financial markets. And we think that this will float some derivatives to the crypto derivatives from the traditional markets. They are easily accessible. It means that literally everybody in the world that have a device, that have a connection to the internet and the Web3 wallet installed in it, they can access crypto derivative and the DeFi as it is. And the second one is that they're easily created. In traditional finance, to create a derivative and to list it, you need a lot of money, sometimes millions of dollars, a lot of people to create and list it, and a lot of time. Vice versa, in DeFi, it can be done by one person, very cheap and very fast, sometimes in a matter of minutes or hours for somebody. Another big block for the DeFi in the future is the debt market. Actually, we have some players in the DeFi and the debt market like Aave Compound or MakerDAO. There you put the collateral and you can take a loan. And of course, there are some projects that take like collateral NFTs now, but they're also at the very beginning. We truly believe that in future, projects and DAOs should have the possibility to emit their own bonds. But to reach to this point, we need to create an infrastructure and really evaluate the underlying risks and also develop the automated smart contracts for their management. So this is the second thing that will be in the DeFi in the future. Also, another thing is the leverage market. It's not actually the derivative, but it's a big block because it uses not the synthetic order books, but the liquid order books. There are a lot of projects now in the DeFi, not a lot, a few of them with the leverage trading that tend to be decentralized, but actually they're mimicking to be decentralized and they're centralized because once you need to deposit assets to any account within the ecosystem, it's already not decentralization. You don't control your funds. In our point of view, and we truly believe that the leverage trading in DeFi should also be totally decentralized. That the user controls his funds all the time, and he only passes the management of his asset to the smart contract, but not passes it to the account within the ecosystem. Another thing is using the liquid book, order book. For example, like UniV3 or the project that will be launching on Aurora that is called Izumi. And the project that represents this type of product is Atomic Green. I'll speak a bit about it later. We have in Atomic Green the lending protocol, the leverage, and the IMM that will be built in the future versions. But it's like a long-term things. How it works. First of all, Atomic Green is the project for the leverage trading on DEXs in the EVM-like chains through the liquidity pools of Izumi and UniV3. So it consists of two parts. The first one is the lending protocol. So it's pretty simple. Everybody knows what it is. It's to lend money and to borrow money. The second part is much more complete, and this is where the magic happens. So this is the controller. For example, when the user wants to open the position short or long, controller borrows the fund from the lending pool. After that, depending on the situation, whether he goes short or long, it sells or buys the underlying assets and positions the liquidity to the UniV3 pool or the Izumi pool in the range a bit higher than the take profit or stop loss of the user. That's why we have the concentrated liquidity on the protocol. And apart from that, I forgot to say that lending gives like 40% APR in stablecoins because of this. Once any of the actions like stop loss, take profit, or market close is triggered, The controller says the underlying assets, repays the lending pool, and then it distributes the P&L and the fee among the lender, the trader, and the platform as it is. When it's liquidation, it's a bit different. It sells the collateral of the person, and it repays the lending and distributes the fees as well. Making it everything, to sum it up, we truly believe that DeFi, let's call it 2.0, is much nearer than we think. And with the mutual collaboration of all the projects that exist in this field, will bring us to the very bright and really prospecting future. Thank you.